You saw $76. You saw red across the screen. You saw panic spreading faster than logic. And while retail investors were selling into fear, a single entity stepped in. 10,000 contracts, 50 million ounces. At the exact bottom of the move, that kind of size doesn't blink. That kind of size doesn't guess. That kind of size positions. The question is not who sold. The question is who absorbed it. And why at that precise moment? Because when institutions change positioning, the market doesn't whisper. It resets. The gold to silver ratio also provides context. Recently, it has stabilized rather than trending sharply. When the ratio compresses, it suggests relative balance between the two metals. When it expands, it signals relative strength or weakness in one versus the other. Right now, the ratio is not sending an extreme signal. That neutrality supports the idea that silver is in a structural pause rather than a directional collapse or surge. The US dollar index adds another layer. It has been trading near a short-term pivot. Silver often reacts inversely to dollar strength, though not perfectly. If the dollar strengthens sharply, metals can face pressure. If the dollar weakens, metals often find support, but correlations are not fixed. He watches the dollar not as a prediction tool, but as a risk gauge. A stable dollar reduces volatility pressure. A sudden move increases it. Treasury yields are equally important. Real yields, adjusted for inflation expectations, tend to influence precious metals. Rising real yields can weigh on silver and gold, while falling real yields often provide a supportive backdrop. Recently, yields have shown signs of stabilization rather than aggressive expansion. That aligns with silver's range-bound behavior. Neither macro driver is pushing hard enough to force immediate resolution. Another element is futures positioning relative to registered inventory. Open interest remains elevated compared to available registered supply. This does not automatically signal stress. It does, however, reflect significant paper exposure relative to deliverable stock. Historically, when open interest remains high into catalyst windows, volatility can increase. Participants adjust exposure quickly as events approach. Premium spreads in physical markets have remained relatively firm compared to the quiet movement in spot pricing. That divergence is not unusual. Physical markets can lag or lead paper markets at different times. It simply introduces another variable. Price may appear calm on screen while underlying demand remains steady. This creates a mild structural tension, though not a confirmed imbalance. As Monday approaches, the time window becomes relevant. The next 48 hours include macro data that could shift expectations around rates and liquidity. Inflation data, policy commentary, or shifts in Treasury auctions can alter the dollar and yield environment quickly. Silver does not move in isolation. It reacts within a broader financial system. Therefore, the open is less about emotion and more about positioning into known catalysts. He frames the current situation as a tightening coil, not because a dramatic move is guaranteed, but because the ingredients of compression are present. Range contraction, elevated positioning, defined levels, nearby macro events. When these elements align, traders shift from passive observation to active preparation. Preparation does not mean prediction. It means clarity around levels. If support holds, continuation of consolidation remains likely. If resistance breaks with strength, expansion probabilities increase. If support fails alongside a stronger dollar and rising yields, downside momentum can build. Each path has confirmation signals. What distinguishes experienced participants is not certainty about direction, but discipline around structure. They understand that markets reward patience during compression phases. Acting too early inside tight ranges often leads to unnecessary losses. Waiting for structural confirmation improves probability. Silver's Monday open, therefore, is not about headlines. It is about where price sits relative to defined boundaries. The market has created a map. Support below, resistance above, macro catalysts ahead, positioning elevated, volatility compressed. He watches calmly. He does not rush to label the market as bullish or bearish. He recognizes that compression is temporary by nature. But he also understands that timing resolution precisely is difficult. The objective is not to guess the minute of breakout. The objective is to recognize when structure shifts from balance to imbalance. As the new week begins, the focus remains on those defined levels. Silver is not in chaos, it is in decision mode. And decision phases are often quieter than people expect until they are not. Positioning beneath the surface. When markets appear quiet, attention often fades. Many participants look for strong candles, sharp headlines, or dramatic intraday swings. Silver is offering none of that right now. Instead, it is offering something more subtle, positioning beneath the surface. And positioning, not noise, is often what drives the next sustained move. He begins by examining futures data. Open interest has not collapsed during this consolidation. That detail matters. When price drifts sideways but open interest remains firm, it suggests that participants are not exiting aggressively. They are holding exposure. Some are building new positions. This behavior reflects conviction, or at least willingness to wait. If traders were uncertain or fearful, open interest would likely decline as positions unwind. Instead, the data shows stability. That stability inside compression is a structural clue. It tells him that the market is coiling rather than retreating. Next, he studies the behavior of intraday volatility. The daily ranges have narrowed compared to recent weeks. This contraction indicates reduced directional momentum. However, volatility does not disappear permanently. Markets alternate between expansion and contraction. Extended contraction phases often lead to sharper expansions. The longer the range holds, the more energy accumulates inside it. But he avoids exaggeration. Expansion does not guarantee upside or downside. It only signals that movement is likely once balance breaks. Another factor drawing attention is liquidity depth near current price. Order book data often reveals clusters near visible levels. Around support, resting buy orders accumulate. Around resistance, sell orders stack. As price trades between them, liquidity thickens. This makes breakouts harder at first, but once enough pressure builds, liquidity can thin quickly beyond those zones, allowing acceleration. He explains this in simple terms. Price moves slowly when many orders are waiting. Price moves quickly when those orders are consumed. The gold to silver ratio also deserves attention again, but from a different angle. While it has stabilized recently, its broader positioning remains elevated compared to long-term averages. This suggests silver is still relatively undervalued compared to gold in a historical sense. That does not predict immediate outperformance. It simply provides context. If risk appetite improves and metals gain interest, silver often reacts with higher sensitivity. He also considers industrial demand narratives. Silver is not only a monetary metal. It plays a role in solar technology, electronics, and advanced manufacturing. While short-term futures trading can dominate price discovery, longer-term supply-demand dynamics quietly influence sentiment. Recent industry reports indicate continued industrial usage strength. However, he does not overstate this. Industrial demand supports the structural backdrop, but does not control daily price swings. Another quiet development is the behavior of exchange-traded funds. ETF flows have not shown extreme liquidation nor aggressive accumulation. Stability here aligns with the broader compression theme. Institutional participants appear to be maintaining exposure rather than shifting dramatically. He then evaluates macro positioning. The dollar index remains near a pivot zone. It has not confirmed a breakout higher, nor has it collapsed lower. Treasury yields show similar hesitation. When macro drivers pause, metals often pause as well. Silver does not need a crisis to move. It needs imbalance. And imbalance often begins with shifts in macro confidence. What makes the coming sessions important is timing. Catalyst windows amplify sensitivity. When markets are compressed ahead of known data events, even moderate surprises can trigger stronger than usual reactions. Traders who waited during the quiet phase suddenly act. Stops activate, new entries execute. Algorithms respond instantly. He views this not as drama, but as mechanical structure. The market is balanced. Balance persists until something shifts perception. A particularly interesting feature of the current setup is the difference between sentiment and structure. Online commentary ranges from extreme optimism to extreme pessimism, yet price reflects neither extreme. It reflects neutrality. That divergence suggests emotional narratives are ahead of structural confirmation. Markets often resolve such tension by forcing one side to recalibrate. He also revisits the support level, but with a refined lens. Support is not simply a number, it is a zone of repeated defense. Each successful defense strengthens confidence. However, each additional test also weakens it slightly. Think of it as a floor-absorbing pressure. The more weight it bears, the more critical the next test becomes. Resistance works similarly. Multiple rejections attract sellers, but repeated testing increases breakout probability. Markets often break after enough participants are convinced they will not. The question entering Monday is not, will silver explode? It is, which side of the range will give way first? He outlines the possibilities calmly. If price pushes toward the upper boundary and volume expands with it, structural breakout probability rises. If price drifts toward support and macro conditions tighten, downside pressure could build. If neither occurs, compression continues, and patience remains the correct stance. Patience is often underestimated. In business and investing, discipline during quiet phases separates professionals from reactive traders. Acting without confirmation inside compression often leads to whipsaws. He also emphasizes risk management. Position sizing during compression should reflect uncertainty. When volatility is low, traders sometimes increase leverage, expecting small moves. But compression phases are precisely when unexpected expansions occur. Prudent sizing protects capital. As the new week approaches, the broader picture becomes clear. Silver is not in trend acceleration. It is in structural pause. Futures positioning is stable. Volatility is compressed. Macro drivers are near pivots. Support and resistance are clearly defined. Catalysts are approaching. This combination does not produce certainty. It produces readiness. He concludes this phase of analysis with a simple principle. Markets do not reward urgency during balance. They reward preparation before imbalance. Silver is balanced, for now, and markets rarely remain balanced for long. The catalyst window and the liquidity shift. As the new week begins, attention shifts from structure alone to timing. Structure defines where price may move. Timing defines when participants are forced to act. In silver's current position, both elements are approaching alignment. The range is tight, positioning is stable, and the next catalyst window is near. He understands that markets do not move simply because price sits at support or resistance. They move when perception changes. Perception often shifts around scheduled economic releases. Inflation data, central bank commentary, and Treasury yield movements can alter expectations in minutes. Silver reacts not just to the numbers themselves, but to how those numbers reshape interest rate forecasts. If inflation prints stronger than expected, markets may anticipate tighter monetary conditions that can strengthen the dollar and lift real yields. In that environment, silver sometimes faces short-term pressure. If inflation surprises lower, rate expectations can soften. A weaker dollar and lower yields often provide a supportive backdrop for metals. These relationships are not perfect, but they are consistent enough to monitor. He avoids predicting the outcome of any single data point. Instead, he studies the sensitivity of the market. When silver trades inside a wide trend, data releases may have limited impact. But when silver trades inside compression, reactions can amplify. Participants are waiting. Exposure is elevated. The first strong push can trigger fast repositioning. Liquidity also behaves differently during catalyst windows. Order books thin slightly ahead of major releases. Market makers reduce risk. Algorithms tighten spreads, but adjust rapidly once data hits. If price approaches a key boundary during such conditions, follow-through becomes more likely. Another layer involves futures expiration cycles and delivery timing. As contracts move closer to first notice dates, traders decide whether to roll positions forward or close exposure. These decisions can create bursts of volume that appear unrelated to headlines. In reality, they reflect mechanical adjustments. Silver's current calendar positioning adds subtle tension to the next few sessions. He also watches cross-asset behavior. Equity indices, bond yields, and the dollar often move together during macro shifts. If equities weaken sharply while yields fall, safe haven demand may strengthen metals. If equities rally alongside rising yields, silver can experience mixed signals. Correlation clusters form during stress periods, and silver rarely moves in isolation. Another aspect worth examining is volatility pricing in options markets. When implied volatility declines during compression, it signals calm expectations. However, low implied volatility ahead of catalysts can reprice quickly. Option buyers begin positioning for potential expansion. If price moves beyond a boundary, volatility sellers may need to hedge, increasing momentum. He explains this simply. Volatility is quiet until it is not, and once it awakens, it can reinforce direction. The key observation entering Monday is that silver's range sits close enough to its structural edges that moderate macro shifts could matter. If price opens and immediately tests the upper boundary, momentum traders will look for confirmation. If price opens weak and drifts towards support, defensive positioning may increase, but he remains disciplined. One session does not define trend. What matters is follow-through. Breakouts without volume often fail. Breakdowns without macro alignment often reverse. Structural change requires confirmation. He also considers sentiment. Surveys and positioning reports show neither extreme optimism nor extreme pessimism. This neutrality aligns with price behavior. Extreme sentiment often marks turning points. Neutral sentiment supports continuation of consolidation until new information shifts outlook. The difference between speculation and preparation becomes clear here. Speculation attempts to guess the direction of the next candle. Preparation identifies the conditions under which exposure should change. For example, if silver holds above support after macro release and volume expands on upward pushes, structural confidence improves. If silver loses support alongside a stronger dollar and rising real yields, risk management takes priority. Each path has observable signals. He does not frame the next 48 hours as decisive for the long-term future of silver. Markets rarely operate in absolutes. Instead, he frames it as a potential inflection window. Compression plus catalysts equals sensitivity. Liquidity shifts are often subtle at first. A failed breakdown followed by strong recovery can be more meaningful than a quiet drift higher. A breakout that stalls quickly may indicate insufficient conviction. Reading these nuances requires patience. He also notes that institutional participation tends to increase once direction clarifies. Large participants often avoid initiating size inside tight ranges. They prefer confirmation. Once price escapes compression, institutional volume can expand. That is when trends gain sustainability. Silver is currently in the phase before that clarity. He watches for alignment, price breaking structure, macro drivers supporting direction, and volume confirming commitment. Without all three, moves can fade quickly. As Monday approaches, the market is not in chaos. It is in anticipation. Futures positioning remains engaged. Volatility is compressed. Key levels are visible. Macro events are near. That combination increases awareness among serious participants. He concludes with a measured view. The next move in silver will not emerge from emotion or headlines alone. It will emerge from structure meeting timing, and timing is now entering the picture. Resolution, discipline, and what comes after compression. By the time Monday's session unfolds, silver will no longer be defined by anticipation alone. The market will begin to reveal whether compression was preparation for expansion or simply a pause before further consolidation. The key difference will not be visible in the first few minutes. It will be visible in behavior. He starts by focusing on confirmation. A true structural shift is rarely a single candle. It is a sequence. First, price moves beyond a defined boundary. Second, volume expands in the direction of the break. Third, follow-through appears during the next session. Without that sequence, breakouts and breakdowns often fail. If silver opens strong and presses into the upper boundary, traders will watch closely for acceptance above it. Acceptance means holding above that level, not merely touching it. If price holds and volume sustains, confidence grows. Participants who hesitated inside the range begin to commit. Momentum builds gradually, not explosively. On the other hand, if silver tests the upper level and quickly retreats, that signals continued balance. False breakouts often occur during catalyst windows when volatility briefly expands, but conviction remains low. In such cases, the market returns to range behavior. The same logic applies to support. A brief dip below support does not confirm structural weakness. What matters is whether price stabilizes below it. If it does, and macro drivers reinforce the move, such as a strengthening dollar or rising real yields, downside momentum can extend. If price quickly reclaims support, the breakdown likely lacked depth. He emphasizes that structural resolution is not about drama, it is about consistency. Sustained direction requires alignment across factors: price action, macro environment, positioning data, and liquidity flow. Another important consideration is how participants react after the first move. If silver breaks upward and new buyers hesitate, momentum may stall. If silver breaks downward and sellers hesitate to press, downside may fade. Markets require commitment to sustain trends. He also considers the broader weekly chart. Even if Monday produces expansion, context remains critical. Is silver breaking out of a multi-week consolidation or merely moving within a larger sideways pattern? Larger timeframes often override intraday excitement. Professionals look beyond the first move. Volatility expansion itself provides information. If implied volatility rises alongside price direction, it indicates traders expect continuation. If volatility spikes briefly and then contracts, the move may lack durability. He reflects on discipline. Compression phases test patience. Expansion phases test emotional control. Many participants wait too long to act during compression and then act impulsively during expansion. This cycle leads to poor execution. A disciplined approach separates preparation from reaction. Preparation defines levels in advance. Reaction follows structure, not emotion. For business owners and long-term investors, this distinction is especially important. They are not trading minute-to-minute swings. They are managing capital exposure. Structural breaks can signal shifts in allocation, but only after confirmation. He revisits the concept of imbalance. Imbalance occurs when one side of the market overwhelms the other. It is visible in sustained volume and directional follow-through. Until that appears, silver remains balanced. Another subtle indicator is how quickly price retraces after a move. Strong markets do not give back gains easily. Weak markets do not recover losses quickly. The speed of retracement reveals underlying strength or fragility. He also acknowledges the possibility that nothing decisive happens immediately. Markets sometimes extend compression longer than expected. When that occurs, volatility compresses further, making eventual expansion more powerful. Patience remains essential. The key takeaway as the week begins is not that silver must choose a direction instantly. It is that the market is nearing a point where direction will matter more. The difference between balance and imbalance becomes clearer as boundaries are tested repeatedly. He summarizes the framework simply. If price holds above resistance with sustained volume, structure shifts upward. If price holds below support with macro confirmation, structure shifts downward. If price remains inside the range, compression continues. There is no need to assign emotion to these outcomes. They are mechanical responses to liquidity and positioning. Silver's story at this stage is not one of certainty. It is one of readiness. Participants who understand structure are prepared for multiple outcomes. They do not anchor to a single narrative. As Part 4 closes, he emphasizes a final principle. Markets reward clarity more than prediction. Clarity comes from defined levels, measured risk, and patience during compression. Monday's open may not be dramatic in appearance, but it sits at the edge of a tightening structure, and tightening structures rarely stay that way indefinitely. The professional framework: reading what others miss. As the first sessions of the week unfold, the conversation around silver will likely grow louder. Headlines will interpret every move. Commentators will choose sides quickly. Some will call for continuation, others will predict reversal. But he understands that markets are rarely decided by opinions. They are decided by structure and response. What matters now is not whether silver moves up or down first. What matters is how it behaves after the move begins. He shifts his focus from direction to durability. Durable moves have characteristics. They hold gains above broken resistance. They defend reclaimed support. They attract volume in alignment with price. Weak moves do the opposite. They spike briefly, fade quickly, and fail to attract commitment. This is where many participants make mistakes. They react to the first push without waiting for confirmation. In compression phases, false starts are common. The market tests both sides before choosing a path. Professionals allow the market to show its hand. He also observes the behavior of related markets during resolution. If silver moves higher while the dollar weakens and yields soften, alignment improves confidence in the move. If silver attempts to rise while yields climb sharply, friction increases. Cross-asset confirmation strengthens structural conviction. Another detail he monitors is intraday closing behavior. Markets that close near their highs after a breakout often indicate sustained demand. Markets that close near their lows after a breakdown suggest continued pressure. The closing print reflects the final positioning decisions of the session. He reminds himself that liquidity drives price more than narrative. Liquidity flows where capital seeks opportunity or safety. If large participants view silver as attractive at certain levels, they accumulate quietly. If risk perception changes, they adjust exposure systematically. These flows rarely appear dramatic in real time, but they shape trends. One of the more subtle indicators he watches is retracement depth. After a breakout, shallow pullbacks suggest strength. After a breakdown, weak bounces suggest fragility. The depth and speed of retracements often reveal more than the initial move itself. He also revisits positioning data as the week progresses. If open interest expands alongside upward price movement, it can indicate new participation rather than short covering alone. If open interest contracts during rallies, the move may be driven by position unwinding rather than fresh conviction. Understanding this difference helps separate temporary spikes from structural shifts. Risk management remains central. Compression can lull participants into increasing size prematurely. Expansion can tempt them to chase momentum. Discipline requires adjusting exposure only after structural confirmation. It also requires accepting that not every move must be captured. He frames silver's current environment as a test of patience and clarity. The market has provided defined levels. It has offered visible boundaries. It has aligned compression with upcoming catalysts. That combination creates opportunity, but only for those who remain measured. He does not see the coming sessions as a turning point for silver's long-term future. Markets evolve in phases. This phase is about resolution of a tightening range. Once resolved, the next phase will begin, either trend extension or renewed consolidation at higher or lower levels. For business owners and investors, the lesson extends beyond silver. Markets reward preparation more than urgency. They reward observation over impulse. When structure tightens, patience increases value. When structure breaks, clarity replaces speculation. As the week unfolds, silver will communicate through price behavior, not commentary. Support will either hold or fail. Resistance will either reject or give way. Volume will either confirm or contradict. These signals provide enough information for disciplined decisions. He concludes with a calm principle. Clarity does not come from predicting what will happen. It comes from knowing what to do when it does. Silver entered the week balanced between defined levels. It will not remain there forever, but whatever direction emerges, structure will reveal it before headlines do. And those who watch structure closely will be ready. Capital rotation across markets provides additional insight. If funds begin flowing into metals while equities stabilize or weaken, silver may find additional support. If capital rotates aggressively back into risk assets and yields rise, metals may face headwinds. Observing where liquidity migrates helps contextualize silver's behavior. Another overlooked factor is consolidation after expansion. Even valid breakouts pause. These pauses create higher lows in bullish scenarios or lower highs in bearish ones. Recognizing these patterns helps distinguish trend development from exhaustion. He maintains a simple framework: breakout Toilet plus, acceptance plus aligned macro plus, sustained volumes toward structural shift, breakout plus rejection, plus conflicting macro, plus fading volume warrants continuation of range. There is no urgency to label outcomes prematurely. Markets reveal strength through repetition. A single session does not define trend. Multiple sessions of aligned behavior do. As this phase unfolds, he reminds himself that successful participation is not about catching exact tops or bottoms. It is about aligning with confirmed structure and managing risk responsibly. Silver's compression phase offered preparation. The breakout phase offers opportunity. The reaction phase offers clarity. He remains focused on clarity. Whatever direction ultimately develops, the process remains consistent. Observe structure, confirm behavior, manage exposure, avoid emotional overreach. Markets change quickly. Principles do not. Silver will continue to move in response to liquidity, macro signals, and positioning shifts. But those who remain disciplined will not need certainty to navigate it. They will rely on structure. And structure, once confirmed, speaks clearly enough. Beyond the move. What structural shifts mean for the bigger picture. By the time silver completes its first cycle of compression, expansion, and reaction, a larger question begins to form. Not simply, where is price now? But rather, has the structure changed in a meaningful way? He understands that markets move in layers. There is intraday movement, there is weekly positioning, and there is longer-term capital allocation. A true structural shift is visible when behavior changes across more than one layer. If silver establishes higher highs and higher lows on the daily chart after breaking resistance, that signals progression. If it fails to hold those gains and returns to prior lows, the structure remains unresolved. Patterns repeat until balance truly breaks. He also studies weekly closes. Weekly structure often filters out intraday noise. A strong weekly close above a former ceiling suggests institutional comfort at higher prices. A weak weekly close below reclaimed support suggests hesitation. What makes this stage different from earlier parts of the week is perspective. Early sessions focus on reaction. Later sessions reveal sustainability. He looks again at positioning data. If open interest expands gradually alongside rising price, participation broadens. That may indicate new exposure entering the market rather than short-term covering alone. Broader participation supports durability. If price rises while open interest contracts sharply, it can mean the move was fueled primarily by traders exiting positions. Such rallies can stall once covering completes. On the downside, similar logic applies. Falling prices with rising open interest may reflect new selling pressure. Falling prices with declining open interest may signal exhaustion. He does not treat these signals as guarantees. They are probabilities layered onto price behavior. Another important factor is how silver interacts with prior swing points. Markets respect memory. If silver reclaims an area that previously acted as strong resistance and then defends it during pullbacks, confidence builds. That defense demonstrates that buyers now view that zone as value. Conversely, if silver struggles to hold reclaimed territory and quickly returns to the range, conviction remains limited. He also observes capital discipline among long-term holders. During sustained uptrends, corrections tend to be orderly rather than violent. During fragile moves, volatility remains erratic. The tone of corrections reveals the strength of commitment. For business owners and long-term investors, this distinction matters more than daily volatility. A stable structural shift allows for measured allocation decisions. An unstable one requires caution. He broadens the lens further. Silver does not operate in isolation from global macro conditions, economic growth expectations, industrial demand outlook, energy costs, and currency trends all interact with its long-term path. A confirmed structural shift must align with at least some of these broader themes. If inflation expectations stabilize and growth remains steady, industrial demand can support silver. If economic contraction accelerates while yields spike, metals may face mixed forces. Context shapes sustainability. Another subtle clue comes from relative performance. If silver begins outperforming gold consistently, it may indicate increased risk appetite within the precious metals space. If it underperforms while gold strengthens, defensive capital may be favoring stability over sensitivity. He also reminds himself that structural shifts can occur in either direction without signaling long-term reversal. Markets trend within cycles. A breakout from a short-term range may represent only the first stage of a larger pattern. Patience remains central. True structural changes reveal themselves over multiple sessions and confirmations. They are not declared by a single candle or headline. As the week progresses, silver's message becomes clearer. Either it has accepted new territory beyond compression, or it has returned to balance and extended consolidation. He returns to the core principle: clarity over urgency. Markets reward those who respond to evidence rather than anticipate it blindly. Defined levels, sustained volume, macro alignment, and time above or below boundaries provide sufficient evidence. Silver entered this period in compression. It moved through expansion. It tested acceptance. Now it reveals whether that shift holds. The final lesson of this sequence is simple but often overlooked. Structure evolves step by step. Participants who remain disciplined throughout each stage, compression, breakout, reaction, confirmation, gain insight that others miss. Silver's next chapter will not depend on noise. It will depend on whether structure has truly changed. And structure, when observed patiently, always leaves a trail.